Want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. This week I have a special guest on the show, Value Stock Geek. He manages investing with his blog and talks about his investing strategy at ValueStockGeek.com. Welcome to the show.
Hey, thanks for having me on.
So first, I just want to understand kind of how you got started investing. You know, what prompted you to be interested in investing? You were inspired by somebody. How did that get started for you?
For me, it all started during the internet bubble. Back in high school, I was in high school. I graduated in 2000, so I was in high school from 96 to 2000. I had always kind of had an interest in investing, an interest in the markets. That really blossomed during that internet bubble. Back then, I was pretty much the exact opposite of a value investor. I was really into the high momentum tech names. You would see it on the news all the time. It was a very exciting time to become interested in investing. I had been using computers for a long time. We had our first home computer in 91. I started using the web around 95. I was very much excited about the internet and its possibilities. I felt that people didn't fully appreciate how the internet was going to change the world. I was probably the biggest internet bull you had ever met when I was a kid in high school. I thought that basically we'd be where we are today in like 2004. So I was really excited about the internet. I bought up all these internet companies. The one I really liked was Cisco Systems back in the day because I figured, okay, they're creating a lot of the infrastructure that's going to power the internet. And I would really just, my research consisted of just going on CNBC. I really had no idea what I was doing. My parents helped me set up a little brokerage account that I put some of my savings in. I had a small group of friends in high school where we would talk about the market all the time, and we really had no idea what we were doing, but we were doing well because we were in the right place. Then at my high school graduation party, I talked to an older family member who's probably about 80 at that point, and he basically heard that I was very interested in the market. I was very interested in investing. He's like, this is a good thing, but hey, you might want to check out The Intelligent Investor by Benjamin Graham. I was vaguely familiar with Ben Graham and Warren Buffett before that. And in fact, I didn't really like a lot of the things that Warren Buffett had said about the internet. He kind of trashed the internet and said, this is a bubble. And my attitude at the time was, oh, he just doesn't get it. This industry is changing the world and he's just not with it. Then I read The Intelligent Investor and particularly the parts about Mr. Market. And I thought about Mr. Market and that whole paradigm about euphoria and fear. And I really thought about what I was seeing on CNBC at the time. I'd see all these analysts, all these anchors pushing these big internet stocks. And I was like, this is it. This is Mr. Market. This is exactly what he's talking about in the book. No one is thinking, what are these companies actually worth? They're just projecting the future. And everybody sees the internet as this tremendous thing. I'm not the only one that sees this as some 18-year-old kid. I don't have any kind of unique insight. That's why there's a bubble in this. So that prompted me to get out of those stocks, and I cashed out my account. I needed it for college anyway to help me out while I was there. And The Intelligent Investor really spoke to me. I was very quickly Buffettized. Shortly after that, I read Buffettology. And I thought about it and I said, well, this makes a lot of sense. You don't just buy with a margin of safety, but you find a good company that trades at a margin of safety, and then you hold on to it for a long period of time. Then in college, I read Buffett's letters, and that all really spoke to me. And after I read all that, I pretty much thought, okay, when I actually have a decent chunk of change to invest, I am going to apply Buffett's strategy. I'm going to find cheap companies that are good, have a moat, have high returns on capital, and then I'm going to hold on to them for a long period of time, and that's what I'm going to do. I was a finance major, so I was learning a lot about the efficient market theory, that type of thing. It didn't really speak to me, but I just kind of learned it. And at the time, I always thought I was going to be a stockbroker or a financial advisor. And I had gone to an internship. I interned for a broker, and I really didn't like the experience. I always thought at the time that brokers did a lot of their own research and picking strategies, picking stocks. And in talking to the brokers, I realized, well, these guys are just like glorified salespeople, and I kind of suck at sales anyway. And at the same time, one of their big things was you have to make a list of everybody that you know, friends and family, and you have to determine what you think their net worth is and reach out to them and then make them invest in our funds. And I was like, well, I don't really know anybody that has a lot of money anyway, so that's probably a waste of time. So I figured, all right, I'll just get a more corporate job. I stayed at college for a couple of years, worked a graduate assistantship, and during this whole time, I didn't really have much money to invest. Then I started working for a more corporate kind of job. By 2012 or so, I had accumulated enough money where I could actually start to invest, and I said, okay, this is the time I'm going to apply Buffett's strategies. And I would usually screen for like low P, low price to book, high return on equity, high growth. I was looking for cheap and good. Then I'd try to learn about the company and figure it out. I had some good wins. I bought like Yahoo, I think around 2013-ish, when it was below book value. And the only reason it went up was because they had a stake in Alibaba. I also bought some duds and value traps. Like I was investing in Easy Corp, a payday loan for basically a check cashing payday loan kind of company, and that didn't do so well. And then after my kind of mixed results, I said, you know what, I really need to figure out what actually works, what guiding principles. Like I have all these theories, I've read all these opinions by Warren Buffett, Benjamin Graham, but what actually works? And then that kind of turned me on to the more quantitative side, where I was more interested in what's the evidence, what actually works, what have people researched and demonstrated that works. Some of the books I read back then were like What Works on Wall Street by O'Shaughnessy. I read The Guru Investor. That was a good book by Validia Capital. I read The Little Book That Beats the Market by Joel Greenblatt. I read some papers I could find online, things like that. And I was really determined to find a strategy that worked for me. And a lot of them were saying, O'Shaughnessy identified some key factors that work. Joel Greenblatt, who was a big influence after I read The Little Book That Beats the Market, was talking about buying cheap and good companies and finding them quantitatively. And then I was like, well, Joel Greenblatt has a good strategy. Perhaps I can build on that. And that's when I started back testing my own strategies. And one of the things I noticed when I started back testing strategies and trying to do my own thing was anytime I added a growth component or a return on equity component or some kind of standard measure of quality to the screen, it almost always detracted from the returns, which is not what I expected. And I thought about that a lot, and I thought about what I was seeing, and I'm like, you know what, this just doesn't make sense. Cheap and good should do better than cheap alone. And I really struggled with this question, and I didn't want to accept what the data was telling me. It just didn't make sense to me. But the more I thought about it, the more I was like, well, the places where you're going to find a margin of safety aren't these situations where everything's wonderful. You read a lot of value investing books, and it's like you want to find a cheap stock that has great management and a moat and high return on invested capital, and it's this wonderful company. It's like, well, why would something like that ever be cheap? Why would I ever get a margin of safety on something like that when everything is going swimmingly? And then I read, when I was thinking about all these things, I read Deep Value by Tobias Carlyle. And that was a real light bulb moment for me, because in that book, he basically taught basically talked about a lot of the things I was already thinking about, where basically cheap alone beats cheap and good. And he cites a number of studies in the book. One of the more compelling ones is a book written in the early 80s. I forget what it's called, but it's by John, In Search of Excellence. That was the book. Where he talks about this book in the early 80s, In Search of Excellence, where the author basically figured out what qualities of companies will do very well. And he identified specific stocks at the time that he thought were great companies based on return on equity and growth and all these other things. And then meanwhile, another analyst, Michelle Clayman, she did a research project where basically she looked for unexcellent companies, companies with the exact opposite qualities of the good companies. And the unexcellent portfolio outperformed the excellent portfolio. And that book is full of examples of phenomena like this, where of what I was seeing in the back test, where anytime you add one of these components to it, it's detracting from it. And it's because you're basically detracting from the margin of safety, getting companies that have less of a margin of safety. And all you're doing is really diluting that factor. So then I pretty much accepted that, and I did some more research. I came across Ben Graham's 1976 study, which I read about in Quantitative Value for the first time, where he talked about low PE companies with low debt to equity ratios. They did a back test on that. They proved that that has returned 15% since the early 1960s. Very simple strategy. And I was like, all right, well, Ben Graham believes in this strategy. There must be some validity to it. I tested it on my own. I found the exact same result. It returns 15% over the long term. Ben Graham was right. He did a back test of his own in the 70s, and it's continued to work since he conducted that first back test. And it logically makes sense. You're buying cheap companies with decent balance sheets, which gives them the ability to kind of survive whatever problem they're mired in. And that's kind of what led to my own little strategy. And then as I was doing all this research and reading all these books, I started to become obsessed with it. And I felt the need to just kind of get it out there, which is why I started the blog and got on Twitter and started talking about all this stuff.
So that's really interesting. I mean, I think your story really illustrates how the times you're in really drive things. I mean, so, you came up during the internet bubble, so you were involved in it, right? It's like,
yeah,
you can't miss what's going on around you. I mean, I certainly got my start looking at some CNBC, and thankfully I don't look at CNBC anymore. But except more of just to get to monitor what the talking heads are telling everyone else. But it's just interesting how every person I talk to that ends up value investing has a similar moment where they say they read The Intelligent Investor or they read something by Buffett and like margin of safety clicks. And that's what I heard from you. Margin of safety just clicks for you, right? Like it turns you on, like value investing makes sense.
Yeah, it's like what Seth Klarman, I heard Seth Klarman talk about this. It's like an inoculation. You either get it or you don't.
Yeah.
I think there's a lot of people who invest in value investing strategies, and they just do it because like the data says that's what you're supposed to be doing. And then they doubt it when it stops working. But I really think if you're going to stick with it, you have to be a true believer in it. And it either immediately captures you and you're like, this is the truth. This is investing. Or it doesn't really click like that.
Yeah. I'm curious, you talk, when you think through your story, have you really thought about why when you say, okay, what Warren Buffett makes sense, I like his strategy, why didn't you just put everything in Berkshire? Because then you could have his strategy. You just follow him, right?
Right. Because at the time, I also realized, well, Buffett is constrained and he needs to invest in these mega cap companies. And I knew I could probably find better bargains on my own if I went into a smaller cap or a micro cap universe. And that was my thinking at the time, where I don't want to deal with those kind of constraints. Warren Buffett's returns were far better when he was dealing with smaller sums of capital than when he was dealing with the much bigger sums of capital in Berkshire.
Yeah, no, I mean, that makes sense. I've found it at times where I've looked back on certain years of my investing and I'm like, man, if I just put this in Berkshire, I would have outperformed my own investing. Even in the recent years, right? Just because you're competing against someone with 60, 70 years of experience versus a more limited take on your own.
Yeah, absolutely.
So
there's a lot of truth to that. I mean, I think investing in Berkshire is probably better than investing in the S&P 500. But I thought, like, well, if I go into the smaller capitalization universe, I could probably do even better than that.
No, I agree. I mean, that's kind of what I followed, a similar path. It's kind of moving smaller, and that kind of opens up more possibility. I find it interesting because I think we all tend to follow a very similar path. So I think towards the end of it, you kind of captured what your current strategy is with, you said you're trying to buy cheap companies with decent balance sheets. Is that kind of what you would describe as your strategy today?
Sure, that's the gist of it. I'm looking for... Ben Graham started off with this he eventually developed this very simple strategy in the 70s where he said, buy 20 to 30 companies with low PEs, low debt to equity ratios, sell them after they go up 50% or after you've held them for 2 years. I've kind of built on that, and I've added some other things. The main things I'm looking at I look at a number of different valuation ratios, not just PE, but I figure if I'm in that universe that Ben Graham was talking about of low PEs and low debt to equity ratios, I'm kind of hunting in the right neighborhood. The other nice thing is with that strategy, it's still applicable in U.S. markets, in bull markets, where net nets aren't really available unless we have a total debacle like 2008 or the early 2000s. So I said, okay, I'm going to hunt in that universe. And then I've added other valuation ratios to it. Like when I'm looking at a stock, I don't just look at the PE. I do want to see a PE, so I know I'm hunting in the right neighborhood, but the best performing factor is the one identified by Toby Carlisle and Wes Gray, which is enterprise value, operating income, the acquirer's multiple. That's one I look at pretty closely. I also look at price to sales. I look at price to cash flow. And then usually what I do is once I've identified something that kind of checks all those boxes, it has low debt to equity ratio, low valuation multiples. I'm also looking at the F score. I'm looking at the Ben-Hashem score to try to determine earnings manipulation. And then once it's passed all those tests, then I'm going to look at it in comparison to competitors in the industry and say, is this cheap relative to similar companies? Is this cheap relative to the company's own history? And then I try to think about it on a qualitative basis. So I'll read the 10K. I'll research what I can online about it. I'll try to determine, these companies are always in trouble. There's always something that the market's worried about. So I try to make my own qualitative judgment as to whether or not this problem is permanent or whether it's temporary. I'm also conscious of the fact that sometimes I might be wrong. So that's why I try to own more positions. I'm not always right. I buy value traps. My attitude towards them is you can do your best to limit them. I think financial quality metrics, as opposed to growth and returns on capital metrics, they tend to eliminate a lot of the value traps. But it's not foolproof. So you need to own enough of them where you can sustain those losses when they inevitably come in.
And so that's like the 20 to 30 positions.
Yeah, and I've also done a little bit of research on that, where most of the academics and Ben Graham both said you should own 20 to 30 stocks, which is good advice. But I also wanted to see, on my own, is that the truth? Does that actually work? So I did my own series of back tests where I tried to look at, okay, if I buy the cheapest enterprise value to operating income stock in the market, what kind of returns does that give me? What kind of volatility does that give me? What kind of maximum drawdowns is that strategy going to have? And then I took it all the way up, looking at multiple numbers of stocks. Like what happens if you get to 10? What happens if you get to 20? And I pretty much determined Ben Graham was basically right. One stock is crazy. You're going to have incredible drawdowns. You're going to have wild volatility. Each stock incrementally adds less and less to reducing max drawdowns, to reducing volatility. Once you get to around 12 to 15 positions, you actually get a bulk of the benefits in terms of reducing volatility. Sharp ratios, they tend to get maximized around 25 to 30 positions. So, and once you go beyond 30, it's almost a waste of time. Like pretty much all of those strategies, whether it's a 10 stock strategy or a 20 stock strategy or a 30 stock strategy, are going to give you the same long-term returns, but you're going to get pretty much all of the reduction in volatility and all of the maximization of your Sharpe ratios in the first 30 positions. And beyond that, in my view anyway, it looks like it's pretty much a waste of time. It almost flatlines after that. And to actually get to the broader markets levels of volatility, you really need to start owning hundreds of positions. And at that point, in my opinion, you're just diluting the value factor. You're just getting away from it. I think we're pretty much in a state where if you buy hundreds of positions that are cheap, you might outperform the market a little bit. You might do like 0.5% better than the market or 1% better than the market, maybe over the long run. But for an individual investor like myself, why would I do that when I can kind of focus on my own strategy that I would expect to do much better than that?
Yeah. I mean, so when you think about, you're doing this quantitative analysis, you're looking at these back tests. So I've always had a certain problem with back tests, and basically it's with the problem. Anytime you do something that you make assumptions, those assumptions can make or break your analysis. So I guess, have you looked at what the assumptions were in your back test, and did they actually make sense with how you manage your portfolio? Like, I think you cited one of yours as using like annual rebalancing. So like, do you annually rebalance then, or like, because if you back test on that and then you don't, that's what I'm kind of walking through.
Right, I understand. Yeah, with a back test, obviously you can really mislead yourself with a back test. You need to know, okay, is this strategy true? And you could construct a back test that makes no logical sense that's going to perform phenomenally well.
Yeah.
So I try to base my own back test on things I know make logical sense, and they kind of reflect historical strategies that have also been back tested, that have also been proven true over time, which are things like Ben Graham's basic strategy of low PE, low debt to equity. So you want to start there. You want to start with things that make logical sense, things you believe in. At the same time, I don't do annual rebalancing. I don't just blindly buy the screen.
Gotcha.
I add my own trading rules to it. A lot of that has just been based on my own experience. For instance, when I notice a company report an operating loss, that's almost always, in my experience, the first operating loss is never the last. And then you'll start to see those companies deteriorate from there. I've seen that in other value traps. A big one that sticks out for me is my investment in GameStop. If I had stuck to a simple rule like that, it probably would have been better to get out of it. I also look for big price run-ups in the stocks that I have. Like if something tends to get to my estimate of its value, I'll get out, even if it's earlier than a year. I've kind of struggled with that because I'm also conscious of the fact that screens and regular rebalancing rules tend to beat human intervention. I'm very conscious of that. There's a lot of research that says that's true, where a lot of value managers, they wind up actually detracting from the pure performance of the factor. A good example of that is Joel Greenblatt. He actually created a brokerage firm where he would buy magic formula stocks for investors and just automate the strategy for them. Then he gave them the ability to go in and pick and choose their investments, to hold cash when they weren't feeling good at the market. And almost always, once they had that level of intervention in the strategy, they wound up underperforming.
Yeah.
So I've struggled with that. My theory about why that happens is because these investors tend not to buy the ones with the scariest headlines. But the ones with the scariest headlines are probably the ones with the best margin of safety that are going to give the best returns of the strategy. So when I'm looking at a stock, I try to distance myself from the fear and the terror that are actually in the headlines about it. And I've also found that I'm outperforming my screens. Even though I've underperformed the market tremendously, I'm actually outperforming my own strategies. So that tells me, at the moment anyway, I'm adding something to it. Perhaps someday I'll go full quant when I realize that isn't true,
Yeah.
and I'll just buy the damn screen. But for now, it feels like, and it looks, and the evidence shows I'm adding something to it. So I'm going to stick with that.
So, but you are checking yourself against it, basically, to see, am I messing myself up?
Right. I'm very conscious of the fact that my behavior might be detracting from the strategy, but so far that hasn't been the case.
So so I want to come back to that, but while we're on this, the purpose of backtesting, I've always had the theory that the reason your analysis, I've seen similar analysis before where basically when you add quality metrics, it lowers the return, basically. So my theory has always been is because the quality metrics are finding companies that would be harmed by stuff like rebalancing. So I mean, if you imagine, you have like a Home Depot in the portfolio and you rebalance that annually, you're going to kill the performance of Home Depot because it might be returning 20-25% a year for 40 years. And when you're taking that off, you're not getting that full return now. That's my theory. I don't know if that's accurate, but
well, I think when you're doing a kind of quantitatively oriented value strategy, you need to be conscious of the fact that you're never going to own a Home Depot. You're never going to own a compounder. You're never going to hold on to something for 50 years and compound it. That's a totally valid strategy. I think it's a really tough strategy to implement because what looks obvious in retrospect is often really hard to capture in the real world. I mean, you look at a lot of these companies and it's hard to distinguish between whether or not they're just temporarily doing well or they're getting they really have some kind of distinct advantage. And in retrospect, it's very easy to look at like Coca-Cola in the 80s and say, oh, that was a slam dunk. But I think in the real world, it's really hard to find those firms. Good example, I tweeted out something that I read. I was reading my old copy of Buffettology from back in 2000, and I saw a list of companies that they thought had moats and high returns on invested capital, and some of them were absolutely bonkers. Bear Stearns was one of those companies. They were all Circuit City, I think, was on that list. So. And it might be easy to just laugh at it now, but you go back to 2000, you go back to when you're in the moment, and it's never obvious. You always think, oh, any company that's doing well today, it's hard to wrap your brain around how that could change.
Yeah.
And you think about today, for instance, and I mean, you look at Google, you look at Amazon, you look at Facebook, it is hard to imagine and totally understand how these companies could fall apart, or how the stocks could not continue to perform well. I mean, Google has the greatest moat ever, it seems like right now. You don't even say, I'm going to use a search engine. You say, I'm going to Google something. Yeah. That seems like an ironclad moat. Amazon, everybody's got the Amazon app on their phone. Everybody's got Amazon Prime. I do it too. When I think of something to buy, sometimes instead of bothering to go to the store, I'm just going to click on that app and buy it. So it's hard to imagine how that's going to change. But all the historical evidence says that is hardly ever the case, that these companies that continue to do well over decades and decades and decades, they rarely deliver on the huge promises that are given to them. And even sometimes when they do deliver, the stock won't deliver because they're so highly overvalued. A good example is Cisco back in 2000.
Yeah.
Cisco actually wound up delivering over the next 10 years from 2000 on tremendous growth, tremendous returns on capital. The business did well over that 10-year period of time, but if you were an investor over that 10-year period of time, you did terrible because the stock was so overvalued in 2000. Another good example, Coke, 1998, Coke looked like, and it still has, an impenetrable moat, a tremendous company. But if you invested in 98, you did no better than T-bills over the next 10 years because it had such a high inflated valuation. I think the reason growth and returns on capital detract from screens is because you're identifying a lot of companies that are just at some kind of cyclical peak. When a company is doing well, when it's growing, it's posting high returns on invested capital, that's just a target on its back. Competitors are going to swoop in and they're going to kill that business. In some cases, they won't succeed, and those are the ones you're going to read about. Those are the ones you're going to read about, oh, if only you invested $10,000 in this company 40 years ago and held on to it, you would have done great. But it's really hard to identify those companies, and it's really hard to distinguish between a business at a cyclical peak or a business with a really good moat that's actually going to continue to deliver over the long term. It's a very, very difficult game to play. And I think if you're doing it in a quantitative sense and you're buying companies that just mechanically look like they have high growth rates and high returns on invested capital, you're just buying a lot of those companies that are just at some kind of cyclical peak and their competitors are going to swoop in and kill a good thing.
Yeah, no, it's certainly really insightful and good feedback there, because I think there's a reason that Buffett switched to his current strategy as he grew in assets, but there's also a reason that even today he recommends you stick to pure value and stay small. And I think he says you can get 50% returns if he was doing it. I don't think he's trying to set that for anyone else, but.
Yeah, I think Buffett's genius in analyzing businesses is actually underappreciated, which seems crazy considering how famous he is and how rich he is. But I don't think when people hear Buffett's strategy, they think, oh, well, that makes total sense. I'm going to buy good companies at cheap prices. But I think they don't appreciate how much of a genius he really is in figuring out whether a company has a moat and whether it's going to do well over the long run. And it's important to note that he switched to this strategy after almost 30 years of investing and 30 years of hands-on experience of trying to turn around troubled businesses, of thinking and dealing with these issues. He had tried to turn around nets. He had tried to, I think Sanborn Map is a good example. He struggled with the board to get them to realize the value of their cash. He tried to liquidate a net and had to deal with the public backlash when he was dealing with Dempster Mill. Then in the 60s, he started to shift his strategy a little bit more to more of the quality names, where he bought like American Express. But even then, he bought it in a period of distress after the salad oil scandal. And then ultimately, he came to buy See's Candy, which I think was a pretty critical moment for him to realize sometimes it's okay to pay up for a business. And he was a very good business analyst. And a lot of that came through the school of hard knocks I think he also tried to turn around a retailer at one point, where he truly understood. He wasn't just an investor anymore. He wasn't someone who was picking stocks. By that point, by the time he changed his strategy, he had extensive experience, and he was very good at it. He was very good at identifying and distinguishing between a good business and a bad business. And I don't know about you, but I think of myself, and I am not Warren Buffett. I don't have 30 years of experience. I don't have that kind of genius level of insight. So the way I look at my own strategy is I might as well try to identify the quantitative factors that are actually going to outperform in the long run, rather than try to operate in that same sphere as Warren Buffett.
No, I think that's critical. I mean, because when you're talking about it and you're like, okay, he switched after 30 years, it's one thing to say, okay, he switched after 30 years because maybe he found it as a better strategy, or maybe he needed 30 years of experience before he was capable of performing with that strategy and making it work. Like, it might be that it's a harder strategy than simple value. And so I think it definitely is.
Yeah, it definitely is a harder strategy. It's probably the hardest thing to do. And I'd say by the time Buffett switched to that, he had amassed a level of capital, you're right, where he had to change things up and he had to identify better businesses and hold them for a longer period of time. He couldn't just flip nets anymore. Plus the nets by the late 60s were drying up. And they weren't available in the large quantities that they used to be. Even Walter Schloss, he was more of a Ben Graham purist. he wound up shifting his strategy. He used to buy almost entirely net nets. And then as they began to dry up, he started to focus more on low price to book names.
Yeah. So I want to switch back to kind of how we were talking about how you compare your performance to your screen. And you also seem to compare your performance to the S&P 500 on your blog. And what I was curious about, and I think this is the question I struggle with for myself, based on recent performance, and a question I think a lot of DIY investors struggle with, is what would cause you to stop investing your money actively? Like, what would cause you to take your money and either put it in the S&P or put it in Berkshire or put it in something that you say, you know what, I either don't have it or it's too much work or something? Like, what would cause you to take that step?
Well, all the money that I have and I invest isn't just the IRA that I track on the blog. I remember listening to Jack Bogle back in the day, and he basically said, if you want to set aside some money for stock picking and for purposes like that, where you're actively picking stocks, he's like, set that aside into a separate account and then have your passive strategy where you're investing more directly. So I have a passive strategy. My 401k, I match David Swenson's recommended allocations. I own a lot of different asset classes. I also have other taxable accounts where I'm trying to buy my own little mix of passive strategies, and I'm not messing with those allocations. I'm not changing them. But I also wanted to set aside a chunk of my savings and kind of really go for it, try to actually outperform the market, and that's what the blog represents. It would take a lot for me to abandon it. I really believe in the strategy. 5 years of underperformance isn't enough for me to throw in the towel. I would say if I continued to underperform after a bear market, after 10, 15 years or something, that might be enough to get me to throw in the towel. But for now, I really believe in it, and it would take a lot for me to abandon it.
Okay. I mean, I think that's certainly a prudent way. I mean, when you've set it up so that you're not putting all of your life savings in this strategy, and so you can really prove out, is this working? Am I, handling it without ruining your entire future type thing?
Right, exactly.
Yeah, I mean, I haven't done that. I basically do all of mine with my active strategy. But similar to you, I've had a tough 2017 and 2018 compared to the market. The market's done wonderfully, so you can, judge that as it is. But so even if you're doing well, you might underperform. But yeah, I think that's prudent. 10 years or something like that is a reasonable amount of time to really test across a multiple cycle.
Yeah, 100%. And I mean, a lot of people talk about how value, and what they're really talking about is price to book large cap value, has underperformed for 10 years. And that's true, but that was never really that great to begin with.
Yeah.
And then I would say most of the smaller cap quantitative strategies, they've really only started to really suck since 2014. Up until then, they were actually doing pretty well. I would expect value and quantitative value strategies to underperform in the late stages of a bull market. And in my opinion, that's where we are right now. We're in 99, 2000. This is for near the end. And that's usually when value strategies suck. When value strategies tend to do really well is when you're emerging from a recession, like 03, 09, those strategies will do extraordinarily well. I would say I would really start to doubt it if we had a big bear market, we had a nasty recession, we recovered from it, and value still wasn't doing very well. That would definitely make me scratch my head. But I attribute a lot of the underperformance of value recently to just where we are in the market cycle. We're in the roaring stages of a bull market. No one knows really when they're going to end, but I'm pretty sure we're very close to the end of it.
Yeah, no, and I think it's certainly for me tested my conviction when you sit there and you see the market going up and you look at the fundamentals of some of the big stocks and you're just like, I don't understand. And you do that for years and you're like, well, my strategy works historically, and it's not price to book, and it doesn't sound like that's exactly what you're doing either in the major stocks. So but it's just interesting. So I want to transition a little bit. Go ahead.
Oh, sure. Go. I was just going to say it's definitely really hard to stick with, but I think that's where pretty much if you're investing in any kind of quantitative strategy, any kind of factor, there's a lot of faith involved in it. And if you haven't had that value investing inoculation where you just believe it or you don't, you're not going to stick with it. And I really think that those periods of underperformance are one of the reasons value outperforms over the long run. You need people to occasionally abandon the strategy. If everybody in the world was a value investor, it would certainly stop working. Those bargains would disappear. That's probably what has happened to something like net in the United States. Everybody knows that strategy works, and it promptly disappeared because of that. So I think it's a good thing. I think it's just a part of the market cycle, and it's a part of what ultimately contributes to value's long-term outperformance.
Yeah, no, I agree with that. But what I want to do is transition to talking about some individual companies, because I think that really provides insight into what people need to be looking out for. And let's start with value traps. So you mentioned when you were talking about value traps before GameStop, and this is the company we both invested in. So I was wondering if you could just give me a little, history about your investment in GameStop. Why were you interested in it? And then also, what made you sell it at the end?
So I was invested in GameStop because it was statistically cheap. It had strong free cash flow. The core business, which I knew was in decline, was selling used video games, where basically you take your games to GameStop, they give you a little bit of cash, you go out and you buy a new game, then they resell that for a lot more than the money that they gave you. That's been a major cash cow for GameStop over the years. I knew when I bought it that was a business in decline, but it was a business that was worth something. And I felt at the time that the business was priced like it was not worth anything. Like everybody knew that, for instance, the newer consoles were going to give you the ability to just download games on demand. And that would pretty much eliminate that cash cow for GameStop. It also gets down to whether or not you want to actually buy your platform, your video game system at a store versus just order it online. That definitely seemed like a business that was toast. But I thought that, this could probably survive a lot longer than people really give it credit for. At the same time, they were buying back massive amounts of stock. They had little debt. So I bought it, and I held on to it, and that turned out to be a big mistake. And towards the end, the hope was, I hope this business gets bought out by a private equity firm who sees the value in this cash flow. And there were talks, there were a lot of articles that you saw back then about private equity firms actually interested in buying the company. Once those talks fell through and the stock collapsed, I just got out of it. It continued to go down more. I know Burry is invested. I know shortly after I got out, Michael Burry got into it.
Yeah.
That might turn out to be a great move for him. But for me, I was just like, I've given this 2 years to work out. They just failed in their attempts to sell. I might as well just admit defeat and move on.
Yeah, I think that's prudent. I mean, so my was very similar to you. It's just like, I know this company sucks in terms of its, future prospects, but it's so cheap. I mean, statistically, it was the cheapest company in I think it was the S&P at the time, or I don't know if it was S&P, but at least it was one of the cheapest statistical companies in the major markets in the United States. And I knew the business. I mean, I don't know about you, but I bought stuff at GameStop earlier in my life, and so I knew what they were doing. It wasn't like it was just some company I hadn't heard of before. But yeah, I mean, I took basically a 50% loss on the position because I was hoping for the buyout, basically. And I should have sold when the news of a potential buyout came out and it spiked, and taken that as my 20-30% win instead of trying to get a multi-bagger. But
yeah, we had similar experiences. I think I got out of there at a 52% loss, but I think the stock's still below where I sold it at. So we'll see. I've moved on. I'm not getting back into it. So, maybe if it becomes a net, I would become interested in it again. But for now, I'm done with it.
Yeah, no, it's just it took up too much of my. It stressed me out holding that company. It just, everything was bad news, getting worse. But so let's talk about stocks that you like. You like Micron, is what I've heard. Tell me about Micron.
Micron is the cheapest stock in the S&P 500 right now. They sell mostly semiconductors. They have a focus mainly on memory. It's, like I said, it's the cheapest stock in the S&P 500. Historically, buying the cheapest stock in the S&P 500 is a pretty compelling strategy. It has something like 30% annual returns. I'm sure at some point there will be some dud that completely collapses and ruins that, but that's what I've found there. With Micron, why is it cheap? Right now, it looks like demand for semiconductors and memory is at a kind of a cyclical high. A lot of this relates to Bitcoin as well. A lot of the server farms and mining operations for Bitcoin depend on or main driver of semiconductor demand. So when Bitcoin peaked around the time that I bought Micron, I think the market instinctively knew that was happening, that there's no way that this demand can continue into the future. So they discounted it to a pretty absurdly low level. I think at one point it had a P of 3 or something like that. So my thinking at the time was, okay, this might be at a cyclical peak, but how much are earnings really going to deteriorate? What are they going to deteriorate by 50%? What does that give it? A P of 6? That's still absurdly cheap. So to me, it just looked like this is crazy cheap and it's insanely cheap. So I'm going to get into it. I was also encouraged because a lot of other big investors that I respect were buying it, like David Tepper and Monish Pabrai. That definitely gave me some more conviction in the position. But that's basically it. I think the market is just overly concerned about all of those worries and all of those concerns about how the company is at a cyclical peak and how semiconductor demand is at a cyclical peak. I think it's just overblown and it's already priced into the stock.
Yeah. So when did you get into this stock? So right now it's trading at like $48 a share. And I had paid attention to you writing about it, but I also paid attention to other people. And I did not realize how it's moved over the last 5 years.
Yeah, I got into it late August of last year, which was definitely early. I should have probably waited, but that's another error I tend to make a lot. I tend to get into these, even if I'm right. Sometimes I get too excited about it and I get into it a little bit early. But yeah, I bought it in late August 2018. It really got destroyed from there. I think this year it's done extremely well. It's up about 40%, I think, so far this year. So it's definitely performed well. And I think Pabrai bought it near the lows. So
in the 30s or something like that.
Yeah, Pabrai was much better with his timing than I was, which is to be expected.
Yeah.
He's known as Pabrai.
Well, I mean, so you look at it now, so I guess some of the lack of demand has shown up because the PE ratio, at least now, I mean, take Google for what it is like 9 or 8 or something. So I don't know, are those numbers real or is it still like a PE of 4 or 5?
I'm not really sure where it is right now. Let me look it up. It's looks like, let's see here. Right now it's at a P of 8.8, which is still pretty cheap.
No, it is cheap.
Price to cash flow 4.6. So it's still a very cheap stock.
Yeah, I mean, I guess so did you, when you bought this, again, you said your focus is primarily looking at numbers, right? So did you do any research like scuttlebutt to say, is this demand actually going to disappear like they think? Or did you just say, this is so cheap, I don't need to do more research? Like, I'll put it in my basket and be done.
I definitely did some research and I looked at the history of semiconductor demand. I tried, and it basically looked like it was at a cyclical peak to me. But at the same time, a lot of it was just simply based on the extent of the undervaluation, or it looked to me like those things that were obvious, those things that I knew, those things that were obvious in doing the research, like I agreed semiconductor demand looked like it was at a cyclical peak back then. I agreed a lot of this had been driven by Bitcoin, and Bitcoin in late 2018 definitely looked to me like it was an insane bubble. I knew those things, but it was just so cheap I couldn't give it up. If it was at a P of 10 or 12 or something, I probably would have passed on it knowing, okay, this industry is at a peak, but at a P of 3, then I think all of those concerns are already priced into the stock.
Yeah, I mean, a PE of 3 requires so much going wrong in order to justify it. I mean, it has to basically be GameStop, where the business is failing forever.
Right. And like I said, I'm very conscious of the fact that humans tend to underperform these very simple statistical screens. So I fully expect the things that I'm buying to be scary. All of them look like, that's the other hard part to figure out if something's a value trap. They all look like GameStop, but they're not. I do my best to avoid those situations, but that's why I own 20 to 30 positions and I don't go all in on one of these ideas.
Yeah, so if the idea is then all you need is, do you need like half of them to not be value traps and half of them real, or do you need like 20% to be value trap? Like, what have you thought about? What failure rate you can accept in your portfolio with the basket to make it work?
Sure. Historically speaking, when you look at the back test and you look at the research, about 60% of them work out, 40% of them don't.
Okay.
So it's pretty much 60-40 is what's actually going to happen. What I try to do is once something becomes very apparent, this is a value trap, I try to get out of it. And like I said, I've done my own homework to try to figure out how that happens. One of the nice things about like a low PE strategy or a low enterprise value operating income strategy is that mechanically you're going to sell as soon as that operating income or as soon as those earnings disappear, because then it's no longer going to be cheap on a valuation basis. And that's why those rebalancings in a value portfolio, I think, are very important. You're getting out of those value traps as you're rebalancing the portfolio. And that's why it's very important to do that. That's probably harder to do if you're more of an asset-based investor, because it can get cheaper on an asset basis and can stay cheap on an asset basis much longer than a PE strategy or an enterprise value EBIT strategy would measure things.
So you're going to have, when I was studying your portfolio changes of the last few years that you've put publicly on your blog, I saw it looked like a 50% churn rate. Does that seem like that'd be a normal churn rate for your portfolio in a year? If you have 30 stocks, you had like 15 or so sales in a year was what I was seeing, 15 to 20.
Yeah, it's a high turnover portfolio. There's no doubt about it. And definitely that doesn't look like value investing when you think about it in the way that Warren Buffett talks about it, where you're buying undervalued companies and holding on to them for very long periods of time. But if you go back to what Ben Graham was talking about you buy after, if you're going to mechanically do this, he recommended that you buy after it goes up 50% or after you've held it for 2 years. That's a pretty high turnover strategy and pretty much matches what I think I'm doing, where I'm selling after big gains or I'm selling after it's kind of apparent that it's become a value trap. In the beginning, I was a lot more determined to hold on to things for at least a year. And I saw that I wound up holding things that were really obviously a value trap. Like one of them was a company called IDT. Another one of them was called Manning and Napier. It was like an asset manager. And to just try to force myself to hold on to it for at least a year, which is what a lot of the mechanical strategies would recommend. It turned out to be a mistake, and I found that my trading tends to add to the strategy. It doesn't really detract from it. Like I said, I'm outperforming my screens. So for me, that's the real benchmark. Like, am I outperforming my own strategy? If my trading rules started to detract from that strategy, I would definitely start to rethink what I'm doing.
Well, I think that's a good trading rule. I mean, I found the same thing. Anytime I've tried to wait for a year because that's what people advise, or even worse, I try and wait for a year to avoid short-term tax gains, it always is a mistake. Like, and there's not that it always will be a mistake, but it's always been a mistake for me, which is, it's a low number of times. But I think once you find out it's a bad idea, it makes sense to sell. But do you sell then always when it goes up to whatever your value is, even if it's not yet? Like if it's 10 months in, are you going to wait the extra 2 months to avoid the capital gains if you're up 60%?
Well, one of the nice things,
or I guess you're in the IRA.
Yeah, it's an IRA, so there's no
Yeah.
tax considerations. But
That's true.
I've also read Michael Burry's letters back when he was running Scion Capital, and he was more of a stock picker. And he talks about something similar in his letters, where he talks about to just hold on to things for a taxable advantage when you're talking about individual stocks. Doesn't really make a lot of sense. If it's obvious that something is at its valuation target, or it's obvious that something is not at its something is falling apart, the turnover doesn't really matter, and it's probably best to just sell it once it reaches your estimate, or once it's apparent it's a value trap. And I looked at his portfolio and I saw that was a lot of what he was doing. He would actually sell. He actually used technical analysis, which I don't really use too much, but I read in the letters, in his Scion letters, that he was talking about, he would often sell when it was down just 10%. If he would automatically get out of it, and that's how he would deal with value traps. So, yeah, it's kind of a combination of what I've read from Burry and then what Graham recommended in his more quantitative strategies.
So is that what you'll do? Is would you sell if you're down a certain percent? Or does
no.
Okay.
Yeah, I don't believe in technical analysis or just blindly looking at the price. I want to see changes in the developments of the business before I'll sell it. If it's down, it certainly catches my attention, and I'll say, okay, there's something happening here. But then I will look deeper and try to determine, is this business actually deteriorating, or is this just a market overreaction?
Gotcha. So I think we've talked a lot about Micron. You mentioned Dick's Sporting Goods to me as well. How, when I look at this, I'm like, okay, I see a retail company. Why is this not just a retail company like GameStop that's going to get, Amazon away?
The way that I think about Dick's Sporting Goods, where GameStop is a business that's obviously in decline because ultimately people are going to be able to get video games delivered directly to their platform. They're going to be able to just download a video game online. Sporting goods, I think, is a little bit different. If you're talking about buying a kayak, or you're talking about buying camping equipment, a tent, or you're buying something that's physically kind of big, you are probably more likely to want to see it in person. Whereas with a video game, you're going to look at maybe a trailer on YouTube or read a review, and that's enough to go ahead and download the video game. I think sporting goods are still items that are something that most people are going to want to see in person before they pull the trigger. And Dick's Sporting Goods, the actual performance of the business reflects that. During this entire retail apocalypse, the business has continued to grow sales, earnings, and cash flow. And I'm not actually seeing a decline in the business, where GameStop was already starting to see the declines because their key cash cow was this business that was in decline. So when I think about Dick's Sporting Goods, it's cheap, it's in a bad industry, but the fundamentals are still doing well, and it doesn't look like this is really being disrupted in the way that everybody's worried about.
Yeah, I mean, and it looks like the stock's done well. I mean, over the last 2 years, it's up 50%. So, I mean, the stock's performing like the business isn't dying either.
Right, and the management also seems to be pretty good. They're returning capital at a very rapid rate. It's currently, they've bought back, I think, 10% of the total market cap in the last year. On top of that, you're getting an almost 3% dividend. The actual business doesn't seem to be declining. So, that's a company that I'm pretty confident continuing to hold because it's still cheap and management is still executing.
So you'll hold it longer than, say, other companies in your portfolio as long as it stays cheap. Like, you're not trying to sell things in a short period of time if they're still cheap, right?
Right. That's just what happens if I either see a decline in the business or it has some extraordinary price run up where the price no longer makes sense relative to where it is.
Okay. No, it's interesting. I mean, I feel like, it's I've shopped at Dick's Sporting Goods. It seems like it is a different business. It's just always hard after, for me at least, seeing, okay, I've done really bad in retail. So I have this gut to avoid retail, but you look at the fundamentals and you're right. Dix looks pretty good. I'm just pulling it up and seeing the stock performance and the business performance matching that. So that's interesting.
Yeah, absolutely. I've been burned by my fair share of retail stocks as well. It's definitely an industry in decline. I talked about this on another podcast, but it's definitely an industry in decline. But that's an industry in decline is where you're going to continually see bargains, and you're going to be able to take advantage of those bargains if you go into it. And you can't be. I don't want to be scared just because I've had one bad experience in the industry that I'm going to completely write it off, because I'm conscious of the fact that those bad experiences are things other investors are experiencing, and that's why other companies in this industry are cheap. And I'm not just going to write it off because I've had one or two bad calls in it.
Gotcha. No, it makes sense. And so the last company I wanted to talk about was you mentioned Flanigan's. Tell me about Flanigan's.
Flanigan's is a microcap. It's one of the smallest stocks that I own. It has a very small market capitalization. It's basically bars and liquor stores in Florida. That's another business that has continued to perform really well. All their locations are in Florida. At the time, I was looking for stocks with high levels of insider ownership in the microcap universe that were also relatively cheap. That was a screen that I was looking at. And I came across this. I read the 10K, went to their website. I did some research on it. And I thought it made sense. This is a really cheap company. It's a business that is not being disrupted. It's a business that's actually doing really well. I'm pretty sure 10 years from now, no matter what technology changes happen, people are still going to be going to liquor stores. They're still going to be going to bars and restaurants. And it's also, when I thought about it a little bit more, it's also in a state that's growing very fast. Florida is growing its population. It'll probably continue to grow its population. Worries about Florida man aside, it seems like people want to live there. They have low taxes. So it's probably a state that will continue to grow. And the business will probably continue to grow organically. In fact, with the small footprint that they have, I forget how many stores they have, but it's a relatively small number of stores and restaurants, they can probably continue to grow. The other nice thing about it is it is an overlooked microcap. That's obvious when you look at the institutional ownership, when you look at the high level of insider ownership. So as the business continues to execute and continues to do well, I think it can definitely do much better once it actually enters an index. Like, it's so small, it can't even fit into the Russell 2000. Once it starts to actually get big enough where it's a component of the indexes, I think it ought to do a lot better.
So you think it would maybe get a higher multiple if it goes to one of those indexes where they can start getting bought passively? Is the idea?
Yes, I think if this was an S&P 500 stock, it's something that would probably trade at 25 times earnings. Whereas right now, just because of the universe that it's in, because it has a low level of institutional ownership, it trades for really low multiples and it's overlooked.
Gotcha. So do you have a preference between buying companies that are micro caps versus mid caps or small caps? I mean, you had mentioned before you want to go smaller, but a lot of the companies you tend to, I mean, you own a decent number of large companies. Like Micron's a pretty large company.
Yeah, I try not to limit myself to a certain level of market capitalization. Like, the way I look at it, it's all about the extent of the undervaluation in a stock. So I don't want to limit myself to a microcap universe, large cap universe. I want to buy value wherever there is. There's value in the S&P 500. There's value in microcaps. There's value all over the place in the market. I might be a little bit more demanding of a higher margin of safety when I buy a bigger capitalization stock relative to the quality of the financials and the business itself. But yeah, I don't want to limit myself, and I want to hunt everywhere.
So when you screen, how easy is it for you to screen those smaller companies? I found it tough to screen for a lot of micro caps because
It's something that is a scary place to go because there is so much garbage in the microcap universe. I feel like you need to really think about those a lot harder than you would for an S&P 500 stock. You kind of have to. There's going to be a lot of frauds. I know back in the day, before I started getting into the more quantitative value, I think I bought one of those Chinese reverse merger stocks at one point. And I think that, yeah, there's definitely a lot of scary things in that universe, and you need to be cognizant and alert when you're entering that world.
Yeah. I mean, so how do you manage the fear of making mistakes then? I mean, because you talk about it being scary, and I think it certainly is when you're investing in something, no one else has heard of, or it's really small, so you might have a very low number of people that can relate to it. But also, you've talked about in this interview that there's you expect a 40% failure rate. So how do you deal with that in terms of your mental conviction and willingness to keep going when you're going to fail a decent percentage of the time?
That's why doing the research on the ideal number of stocks to hold in a portfolio is very important for me, because I was very cognizant of the fact that I'm going to buy value traps, that these situations won't always work out. So that's why I want to own enough stocks where the value traps won't overwhelm and destroy my portfolio. That's the reason I'm kind of against the more intense concentration that a lot of other value investors have. Like when you read, for instance, You Can Be a Stock Market Genius by Joel Greenblatt, he's talking about a very research-intensive portfolio where you're going to own 5 to 8 positions, something like that. I'm not confident enough to go out and buy 5 to 8 positions. So that's why I did the homework on the ideal number of stocks to hold in a portfolio. When you own a position that's 10% of your portfolio, goes down half, you're going to lose 5% of your portfolio. 20 stocks, one of those stocks goes down 50%, you're going to lose 2.5%. So that's why I try to own enough positions where one value trap won't destroy the entire portfolio. I tend to think of things more at the portfolio level than at the individual stock level.
So do you think it's possible to reduce that 40% failure rate to a 10% or 5% failure rate?
I do. Yeah, I definitely do. I think you can improve on that. And I found that the best way to do that is to focus on financial quality metrics as opposed to growth and returns on capital metrics. That the companies that tend to turn out to be the value traps are often the more leveraged situations. And another thing that I try to do is I try to get out once I start to see that the business is actually beginning to deteriorate and the headlines look like they're coming true.
Do you think a lot of other investors do a similar thing, and that's part of what causes bear markets aligning with recessions? They see a decline in business and they sell. Do you think that's would fit, or what else matches that?
I think, when you think about bear markets, you're going to see it more on the broader market level than you're going to see it at the individual stock level, where during a bear market, it tends to be a situation where they are selling everything. They don't care what it is. Everything is going down. There is no place to hide. You go back to 2008, I can remember this palpable sense. It was in the air. The world is ending. Everybody was worried about it. I think that's more of the situations that create the bargains in bear markets like that. Once really people have begun to feel like the world is over, and it never truly is. And if the world was over, it wouldn't really matter.
Yeah,
what you have in your portfolio anyway. So you might as well swing for the fences.
Yeah, I think Buffett had a quote. Maybe it wasn't Buffett, but someone, a famous investor, had a quote something like, "Well, if nuclear warfare occurs and it wipes my portfolio, well, I'm dead anyway, so doesn't matter." So, but are you structuring your portfolio to avoid a bear market, or is it just you don't care what part of the market cycle we're in? The strategy is the strategy.
No, I really care about where we are in the market. I know that all of the big investors that you hear, whether it's Peter Lynch, whether it's Warren Buffett, they advise so strongly against timing the market, trying to figure out where we are. Like right now, I hold a good amount of cash. A lot of that is because I think we are headed for a recession. I think we are headed for a bear market. I look at the yield curve. I think that's a really important thing that has predicted every recession. In the last two recessions, like I can remember watching CNBC in 99 and hearing, oh, well, this yield curve inversion doesn't really matter because I think at the time they were talking about the budget surplus. They were like, the budget surplus is manipulating interest rates, and that's why it doesn't matter. In 2007 and 6, they were saying, oh, it doesn't matter because there's this savings glut. And all of these people in emerging markets that have a ton of savings are piling their money into U.S. markets, and it's unnaturally depressing longer-term interest rates. There's always some, and now you're hearing similar things. Well, interest rates are negative elsewhere in the world, and we're in a new paradigm, and it doesn't matter anymore. But we're 10 years into a bull market. We're 10 years into an economic expansion. Consumer confidence is near all-time highs. Unemployment is near all-time lows. And the yield curve just had an inversion. Typically, that means that trouble is brewing. And even though Buffett will say you shouldn't try to time the market, at the same time, he holds over $100 billion in cash. He might say, well, that's not timing the market. I just can't find good bargains. Well, you probably can't find good bargains because you're at the peak of a market cycle.
Yeah. No.
So I definitely think we're headed for problems, and I'm conscious of that. So that's why I want to have a little dry powder to take advantage of it when it happens.
No, it makes perfect sense to me. I find the interesting one because I wasn't aware of the 99 where it's like, oh, it doesn't matter because the budget surplus is manipulating interest rates, and what we've gone from that to the Fed just being like, we'll straight up manipulate them to zero anyway, and yeah, so it's like it doesn't matter because we're just doing it straight up this time instead of pretending it's something else.
Yeah, and I felt we have been overvalued for a long time. I felt that since. I like just looking at these things on a CAPE ratio basis. It's looked like this market has been overvalued for 5 years right now. And a lot of the bears are being mocked because they were short, because they've been saying this forever. And we're at a point now where they're the boy who cried wolf. People are saying, oh, well, they've been saying that since 2013 and they've been wrong the entire time. Why are they right now? I think a bubble needs a pin to prick it. It needs some kind of event, some kind of catalyst to come along and wash everything away. And I think that the error that a lot of those bears made 5 years ago is that they weren't looking at the yield curve. Back in 2013 and 2014, the yield curve was very steep. The Fed was continuing to pour liquidity into the market. Now we're coming off of 2 years where the Fed has been very tight. The Fed has been reducing balance sheet in earnest since 2018. They were raising interest rates for most of that time. Now they've just reversed course and they've just brought back QE and they're cutting interest rates. But if you look at the history of Fed actions and the yield curve, typically by the time they begin doing that, it is too little too late. And I was listening to another great podcast with Cam Harvey and Med Faber, where Cam Harvey is the person who discovered the impact of the yield curve and the impact that it has on recessions. And he was talking about how basically the length of a recession is the length of the yield curve inversion that previously happened. The yield curve always uninverts before the recession ever happens. It gives you a year or two ahead of time of warning that this is happening. The yield curve was just inverted, I think, for 3 or 4 months. That probably means at some point in the near future, we're going to have a 3 to 4 month recession, which doesn't sound like the end of the world. But I think when you're coming into the situation with valuations as high as they are, you're probably going to have a really big decline in stock market indexes. Another thing I'm cognizant of is I know that in most recessions, value tends to get crushed with everything else. But I also struggle with whether or not we're in a situation like the early 2000s where value continued to do well, even while the broader market declined, even while we we endured a recession simply because those value stocks were already so cheap going into it. So I question, are we in a similar situation right now? That's why I continue to hold so many value stocks, and I'm not 100% cash. But I'm very conscious of the fact that we're probably headed for something.
It's very good insight. Thank you. So I think we're pretty close to the end of our time. So I'll just ask you, how would you like people to find you? How follow you? Your Twitter, your blog. How would you like just kind of promote yourself for a bit?
The best place to follow me is on my blog, is on ValueStockGeek.com. There's a follow button there if you want to follow and receive emails every time I post something new on the blog. Those are usually more extensive, more in-depth thoughts than you'll find on my Twitter account. You can also follow me on Twitter. I tend to just comment on things real time. I post articles that I think are interesting. I follow people that I think are interesting. It's just kind of a fun way to spend some time. But yeah, if you want to see my more in-depth thoughts about where I think I'm doing with my portfolio, where I think things are heading, the absolute best place is ValueStockGeek.com, which is my blog.
Awesome. Well, we will link to you there. Thank you for coming on to the show.
Yeah, thanks for having me. It was a lot of fun.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.